Hello, and welcome to another episode of the Retirement Café Podcast with me, your host, Justin King. If you're thinking about your retirement or already retired, you're in the right place. My aim is to help you plan for and live a successful and meaningful retirement. Retirement is far more than just a financial event. It's a significant life event, a major transition, which will bring with it new challenges and opportunities. So each episode contains tips, information, and inspiration to help you feel more informed and confident about your retirement. I hope you enjoyed today's episode. Hello and welcome to the Retirement Café Podcast. I'm delighted you can join me today. I'm also really pleased to welcome as my guest today, solicitor Lucy Obrey. Now, Lucy is a partner and head of private client at Higgs LLP, and with over 20 years experience in estate planning, Lucy specializes in helping entrepreneurial clients with wills, trusts, and succession planning. She's also a member of the Society of Trust and Estate Practitioners, known in short, STEP. Now, I was really keen to talk with Lucy after seeing her present at a conference I attended recently to unpack the potential impact of proposed tax changes on business owners, landowners, and anyone with significant pension assets. In our conversation, I'm going to discuss estate planning strategies that might be helpful leading up to and after April 2026, when the tax changes are due to come into force, so that you can make informed decisions about your retirement and, of course, your legacy planning. Welcome to the podcast, Lucy.
Oh, thank you so much, Justin, for having me. I'm really looking forward to this. So it's quite a build-up, but I'm excited to be here. And as you said, there is plenty to talk about. And this might be the start of a few podcasts on because yes, there's a lot to navigate.
Yeah, I tell you what, I mean, you could have never been so popular, surely.
Well, yeah, I do feel, very popular at the moment. That there's lots and lots of inquiries. It's very, very busy, and it's never been, more important to take advice, really, on all of this, because it is so complicated.
Yeah, I mean, it is nuts, and it feels like inheritance tax and this type of planning was for a lot of people was a bit of a kind of a sideshow. It's not really relevant to me. But of course, we've had frozen nil rate bans over the last, God knows how many years. More, asset prices going up. More and more of people being kind of drawn into the inheritance tax kind of world. And then, of course, we get the bombshells the government has come out with recently, which is let's bring in agricultural property, let's bring in pensions. I mean, it's all going on.
It is. And I think as well, Justin, when you look at the individual who might not have been concerned about inheritance tax because they built up a significant pension out of the estate, because they got a successful business that was trading out of the estate, estate planning wasn't on the agenda. And all of a sudden, without any notice and with a very short timeline, and that world is potentially going to dramatically change.
Yeah. And Lucy, this is one of my first thoughts that I've been, if you were very wealthy, I don't know, I'm going to imagine you're a duke of something, and you've got a huge estate. And we all are familiar with a kind of the 7-year rule, give something away 7 years, survive 7 years, and as long as we don't still enjoy it, that's absolutely fine. It's left our estate. And if you're very wealthy, you can probably afford or possibly can afford to give a large amount of your estate away 7 years before you die. Now, of course, you may not know when you're going to die, but with a average life expectancy, you kind of go, well, maybe in my 60s or 70s, hopefully I'll survive 7 years. So for the very wealthy, they have still this real strategy of being able to give stuff 7 years away 7 years before you die. But for the rest of us, all of a sudden we don't want to give our house away because we need somewhere to live. We don't want to give our pension away because we need something to retire on. We probably may not want to give the farm away. This feels like it's possibly, I don't know, it's taxing. It's still not maybe taxing the right people, but I don't know what your thoughts are.
Well, it's interesting, isn't it? Because where you've looked at estate planning traditionally, and you will have given this financial advice over the years, it's always use the pension last.
Yeah.
The pension's out of the estate, tucked away and not in the inheritance tax net, no 7-year rule to worry about. And I think that's given comfort to people who perhaps then have made a gift with a hope of living 7 years because they've known the pension is there behind the scenes intact. And that, I think, has worked very well for a lot of families. But that in itself is interesting, isn't it? Because we've had the pensions consultation. It's probably worth pointing out we've had no further detail come out of that. So we don't really know how this is going to shape out and work in practice. But what we believe is going to happen is the inherited pension will be added to the estate on death. Yeah. That's enormous in terms of how people have thought about their pensions, because potentially we're in the arena, aren't we, of rather than spending the pension last, do you try and extract it? How do you extract it? Can you extract it? And if you can, are you then in a position where you can give some of that away? Because you're absolutely right. You might be in a position where you can't.
Now, from what I understand, just so that our audience get the kind of real basics, the intention of the pensions, the changes to the pensions are still that husbands and wives or spouses will be able to inherit each other's pensions, and the tax bill, as all inheritance tax is, in essence, it's not taxable between spouses.
That's what we anticipate, but again, we haven't had the final detail. So the way inheritance tax legislation has traditionally worked is, you're right, there's never been an inheritance tax charge where we've gone husband to wife, wife to husband. So you'd anticipate, wouldn't you, that would continue. But we need to keep an eye on that. Yes.
Whoa, this is a can of worms. Right, where do we start?
So I think I had some very interesting conversations with clients and business partners in recent months. And the starting point is clearly, I think, understanding what you're worth. And so when I go back to that, that client who's got that large pension or they've got that valuable business, they haven't really ever obsessed about what it was worth. Apart from, it's nice to know what you're worth, and we all like to know that, don't we? But from a tax point of view, they never really worried about it because they've known those assets aren't coming back into the estate. Yeah. So I think there's a key piece of work in terms of getting your affairs in order before you can even start to have the estate planning conversation about understanding the total of your worth and that being looked at scientifically. Now, you can talk much better than I can around what the pension is worth. That's a much more straightforward exercise, isn't it, than what the business is worth or what the family farm is worth. But I've had clients recently coming out and said, well, what's in the pension pot? And they've said, I don't really know because I haven't drawn anything from it, don't really need it, thought I'd pass it on to the children. I'll have to have a look.
Yeah.
Which is incredible, really, because you should know the value of that, shouldn't you?
You could. But of course, also people end up with lots of different pension plans, don't they? I mean, especially in the age of auto enrollment, the idea that you get enrolled into a pension as soon as or quite quickly after you start working with an employer. If you move employer a number of times, you can end up with pension plans with numerous providers.
Absolutely. So that detective work, and the earliest the changes with pensions we anticipate are coming in is the 6th of April 2027. So we have got time. And there's no need to panic or rush here. But equally, the quicker you can just get the data down and know exactly what you've got, you and I think, then can come in and add value potentially, because we can look at the assets and start to come up with a potential plan. So when you say to me, where you start, I think the starting point is quite basic. You've got to know what's in the estate. And that includes assets that we would previously have ignored. So, the family business conversation, I think it's worth somewhere between 5 and 10 million. Where we knew we'd got the relief available in full, that was fine. But that isn't going to help somebody strategically plan moving forward. So there's a massive opportunity for anybody who's an expert at share valuation. They're going to be incredibly busy.
Absolutely. So, okay, I kind of feel that pensions are relatively easy to value, except of course if you're owning your commercial unit within your pension, which of course is a possibility, and therefore we need a proper valuation there. But you're right. We've got an investment fund and a pension, daily priced, got a value. Thank you very much. Then we've got possibly property assets, a little bit more difficult, but a regular value will be able to provide a valuation. Then we have these people that you're talking to, the entrepreneurial client, the person who may have the business that they're going to pass on, and then also other people who've we're trying to obtain the agricultural relief, or that's what they do. They are farmers. Let's talk about the business asset first of all. So the first thing to get the valuation, you say?
Yes, and I think, it's worth making the point. The timetable on the business and agricultural changes is different to the pension. Right. So if this wasn't confusing enough, that we're running two timetables. So the consultation on that has now started, due to end at the end of April. And the changes, if they come into place as anticipated, 6th of April 2026. So we've got a little over 12 months. Now, there could be, and I say could, and I hesitate, and to be more certain, once we've got the consultation, I think there's likely to be a window of opportunity where business and landowners will be considering moving those assets on before the changes come into place. And we can talk about why that might be relevant in a moment. So again, there's no need to panic. We've got a 12-month window, but that will go very quickly, whereas we've a couple of years with pensions. And again, it's very difficult to sit down and work out a plan if we don't know what the value of that asset is. Now, we could have, 3 or 4 accountants, couldn't we, join us now, and we could give them a hypothetical business scenario, couldn't we? And they'll all come up with a different number, and they'll all be right. And they all have their methodology, and you and I won't be able to unpick it other than to say, yes, that all seems absolutely fine. But ultimately, a family business is worth what somebody's going to pay for it, isn't it? Yeah. That's why families sell. Yeah. But we need a number, and it's the number that the revenue will agree with you as at date of death. That's the planning number, isn't it? It's not necessarily the number you would sell for.
So let's just take a step back and understand, for people who are brand new to this, what are the standard reliefs that are available? And then what are the reliefs going to be available on business assets?
So, it's a very good question. As you said, it's always good to understand where we are now. And again, some caveats where we might be going. Yeah. So business relief in particular has been such a valuable relief because if you qualify for it, and simplifying, if you like, the subject matter, if you're broadly trading, there was an acceptance that you didn't have to pay inheritance tax on that business when you passed away, because there was a recognition that the value was caught up in that business and therefore there wasn't the cash available to pay the tax. That's the starting point. And it's served many entrepreneurial families in this country well over the years, where they have been able to successfully transfer the business from mum and dad to the children or to the generation beyond that. Agricultural relief, similar way, but there are sort of two tiers of relief. And again, let's not get into the detail of that now. Broadly speaking, it was available as 100% or 50%, depending on caveats. But again, very, very valuable because it allowed farming families without access to cash to pass that farm on to the next generation. So it was tax-free, effectively, and still is until the 6th of April, 2026. And that's why I say I think there will be a window of opportunity potentially to look at those gifts. Now, those families, I think, traditionally have only passed the value on while they've been alive if they've wanted to incentivise the next generation. Because I think there is something nice, isn't there, if you're invested in a family business, that you own something in it. So we've had lots of conversations and plans over the years where we've actually transferred some wealth down while mum and dad have been alive, but it's never really been driven by inheritance tax. It's been driven by incentivisation. And parents might have kept the value and on second death, we have no inheritance tax to pay and that asset goes down either outright or where there's been concerns around asset protection for the children, we've possibly used a trust in the will as well. Yeah. I think the headline has been nobody's been finding cash to pass those assets on.
No.
That's the position, that's now.
Yeah. What's the proposal?
Yeah, so the proposal is the relief isn't going completely, but it's going to be reduced. So the reduction, and again, we need to see how the consultation pans out. But the headlines seem to be you can have £1 million of value that still goes in the old way, so tax-free. And thereafter, the balance of the value is going to be 50% no inheritance tax and 50% chargeable. But I think a simple way for perhaps you and I to explain it is it's a 20% tax charge, isn't it, that's over and above the million. That's the position. You'd also have your own nil rate band allowance, the 325,000. Nothing has changed on that apart from it's being frozen. And so we're stuck with that number for a number of years still to come. So you're essentially at 1.325 million, aren't you, as a headline? And then you've got to find the cash now to pay the tax charge.
Right.
Now, there are lots of points that we need to unpick on this. And again, we're not going to be able to get into the detail of it today. But there seems to be a sense from the sort of the government who made the proposal that, one, this doesn't seem to affect many families, which I found myself to be bizarre because I could make a list of the hundreds that I looked after, and that's just me. And so I thought, that doesn't seem quite right. And two, there's a suggestion that it can be paid over 10 years. So, you haven't really got to sell the business or the family farm. Don't worry about it. We're going to let you pay it by instalments. But it misses the cash flow point, doesn't it? That it's still got to be paid.
Wow.
So it's a massive shift.
And I suppose families could be looking at, right, can I give it away earlier? Can I give it away and survive the 7 years? Is that a strategy?
I think it is. But I've tried to, when I've had those discussions, really tried to push the individual. If they didn't have that tax change looming, is that the right thing to do from a succession point of view? And I had a conversation last week with somebody where he'd been very concerned to pass over the shares to the son because he didn't like the girlfriend. And he was concerned the son was very keen that she might be marrying into the family. And so I said, so we weren't passing those shares down, but as a result of the tax changes, we now are. Are we really doing that? And he did have to pause and say, no, you're right. I'm just moving the problem from one place to another, potentially, aren't I? So yes, I think there will be families where they will now accelerate the gifting, and we will need to give some very careful tax advice around that as a concept. But that is a possibility. Try and gift it, shift the value out, and it's for 7 years.
And I'm imagining there's some tax consequences on those gifts.
There are. We talked, haven't we, really exclusively about inheritance tax, because that's the tax that impacts on death. Now, without getting too technical, and how can I put this? I'm sure I won't offend anybody by saying dying for capital gains tax purposes is rather a good plan, isn't it? Because at the moment you get an uplift. So all the gains are wiped out. So whenever we have gifts of family companies or, landed estates, etc., in an estate, the capital gains tax situation evaporates. But of course, if we're now getting into lifetime gifting, we have got to run the capital gains tax analysis alongside the inheritance tax. And those two things can often cause us an issue where we've got a gain. So there's going to need to be a strategic plan around it. But it all goes back to the value, doesn't it? You can't give that advice without knowing what we're talking about in terms of the numbers.
No. So you can't look at this inheritance tax in isolation, because if you start giving it away, you could be causing yourself capital gains tax issues. And therefore, you've got to make sure that you don't end up paying more tax on that front than your beneficiaries would pay on inheritance tax.
Correct. And there are reliefs. And again, if we're putting together a technical estate plan, there are lots of other plans we can take with CGT. But as a headline, you have got to run the two together. And I think people don't necessarily appreciate that, because that's not an issue on death. The two positions are, it's a very different starting point. Yeah. And the asset, I don't know about you, but I have as many conversations with clients about asset protection for the next generation as I do about the tax and that appreciation that this hard work, and they've grown these assets. They could, the pension was out of the estate, the business assets were protected. They could largely deal with that with a well-drafted will structure with a trust. But if we've got this acceleration now to gift, there are some interesting dynamics there, aren't there, around prenuptial agreements, postnuptial agreements, cohabitation agreements. And they're not easy conversations, are they, between mum and dad and the next generation?
No. Now, I know one of my most popular YouTube videos in the recent months has been about trusts.
Has it? Okay.
All of a sudden, people want to know about trusts because they hear the rich and wealthy use trusts. And if I can get it all into a trust, then it's outside my estate. And I'm also protecting it from maybe those relationships that my beneficiaries might get into in their younger years, which could cause this loss of capital. So can you give us a bit of a synopsis about where trusts fit into all of this?
Okay, how long have we got then? Let's try and simplify this. So I think in the context of what we're talking about, trusts have been very popular for families who have wanted, for whatever reason, to remove some value while they've been alive, but they haven't wanted to give the asset away outright. Yeah. And in that scenario, under the current rules, if you qualified for that business relief or agricultural relief at 100%, you could get an unlimited amount of value into a trust. Now, I get very excited about that. So, that's a podcast in itself, isn't it? The excitement of being able to get millions and millions into trust, potentially with no tax charge. How is that possible? It is possible, but it's because of the very, very generous business relief and agricultural reliefs. So we've got lots of families who've taken advantage of that over the years. And it's been particularly exciting for them if they've sold later on. Those sale proceeds are in the trust. They're not back in their estates. And so that's worked very, very well. And trusts, again, they've fallen out of favour a little, haven't they, with pensions? Because when pensions became much more flexible and the ability to have flexible drawdown, they lost their attraction. But I've still been, a fan of a pilot trust, where the pension death amount has been nominated in for the right reasons, for control, where we've wanted to make sure that nobody can draw down on that without the trustees say so. And again, there have been some very attractive numbers coming out of those, those pensions when we've been able to get them out tax-free. So I think in the context of what we're talking about, they've been the big uses of trusts. And then it's the death position. So where we've wanted to protect the succession to an asset and we've got that relief, we can leave it under a trust, under a will, and pay no inheritance tax. So why wouldn't we put it into a trust and potentially protect the value of the estates of the next generation? So that's been the real use of trusts in this context. Yeah. Where might we go next with trusts? Well, that's interesting, isn't it? Because, again, we've got to have the details of the consultation. But if it works through as planned, it would appear that there'll be a restriction in the context of business and agricultural relief, that we could get the $1 million in. You could probably, I think, the way it will work, also add on the 325,000 if you haven't used it already in the 7 years. And then thereafter, it looks like you hit a tax charge. Quite what that will look like on a lifetime trust remains to be seen, but there'll be a tax charge. So that in itself is going to restrict, isn't it, the value of what you can put in without paying some form of tax charge. So that will be a game changer, I suspect, for lots of families who haven't got the cash to pay it.
Yeah. And then I think I'm right in saying, of course, if you've got a family business with a husband and wife, they will have £1 million allowance each for business assets if they own the business, as a 50-50 shareholders.
That's my understanding, subject to the consultation. It's getting a bit dull, this, isn't it? Subject to the consultation detail. And that's what's so difficult about this. We haven't got the detail. But yes, I understand the position to be in your example, per shareholder. So that was husband and wife and 2 children. On the face of it, they've all got the £1 million allowance, one each, and they've all got their nil rate band. So there's some interesting planning potentially emerging, isn't there? Mm. And around making sure that everybody has got the right number of shares to potentially take advantage of their individual allowance. Yeah. The other point, Justin, which is interesting, and again, we haven't got the detail, is whether it's transferable between a husband and wife. Because again, you would think it would be in the context of the legislation we've got. Well, I haven't seen anything definitive about that.
No. And so what you're saying is a bit like the inheritable nil rate band for residential property, or the residential nil rate band, and the regular nil rate band. Obviously, they're inherited or can be inherited. Not obviously, because a will can direct it differently, but they can be directed or inherited by the surviving spouse. And what you're suggesting that here is that maybe the £1 million allowance for a business would also be inherited by a surviving spouse.
I think it's a suggestion. We want to rely on it at this point. No. But logic would say that would seem to make sense, wouldn't it? But there's very much that's logical about these proposals. So we await the detail. If it isn't transferable, there's an interesting exercise, isn't there, around having to look at who's got the shares, and if you have got a husband and wife, making sure we maximise both the allowances.
And of course, possibly, deathbed planning. Do you inherit it? If you know when you're going to die, because sadly you've been diagnosed with something terminal. Is there a transfer of shares prior to death? Which puts you in a better tax position. But of course, the other thing that comes into play here about the capital gains and business asset disposal relief, and even though you're owning a business asset in the next 12 months before the legislation changes, and that's transferred into trust, we're suggesting at the moment there isn't a tax bill on entry into the trust. Is that is that the case?
It is, yeah. I think there's a couple of points there, and probably one that's just worth flagging. And again, further detail weighted. He's generally speaking, you have to hold an asset for 2 years to qualify for the relief in the first place. So when we talk about deathbed planning, there is always that sense check of, well, if I transfer it, has the person held it long enough? And we don't quite know how that's going to work. So I think that's a subject of a podcast in itself in the months to come. You're right about our understanding being at the moment, the rules haven't changed. So there is still the ability to get an unlimited amount of value into the trust as long as we're happy the asset qualifies. What is very challenging is being able to advise with certainty on how that trust is taxed as it then goes along. So at the moment, under the old rules, we transfer, let's say, £5 million of trading shares in. They go in, we pay no inheritance tax. If we keep those shares in the trust, because that's the plan for the company to continue, when we come to the 10-year point, or if we ever want to distribute those shares out to somebody, we also know at an exit point we can claim the relief to get us out tax-free. Now, what we think will happen is we won't have that luxury even if we go in under the old rules once we hit the 6th of September 2026. And this is why we've really been saying to lots of our clients, let's just pause until we've got the detail, unless you really, really want to get this transfer in, because none of us can advise with any certainty what the tax liability might be for inheritance tax purposes to get out. And I've never been a lawyer who's wanted to put a client into anything without understanding how we get out and what the tax arrangements are.
Yeah.
So that potentially might be still fine. They will just understand there needs to be a cash fund somewhere, doesn't there? So that at the 10-year point, do we have our £1 million, for example? Do we have the trust 325? And is it then just the small tax charge on the balance? That might be palatable. It might be fine. But we need to understand it.
So just taking a step back there for people not familiar with how trusts are taxed. And I'm sure you can guide me on this, but we're talking about placing the asset into a discretionary trust, which won't have a tax because of the type of asset. Won't have a tax charge going in, but every 10 years the value of the trust will have a tax charge. Now, am I right in saying that it's usually the value of the trust? Well, I suppose if it's still holding business assets, it may not have a tax charge at all. But if it's not holding the business, so yes, I see what you're saying and how the complication happens here. That what is that 10-year tax charge going to be based on? That other regular or discretionary trusts, if they were held in just investments per se, would have a 10-year tax charge on.
Yeah. So traditionally, when we put, trading assets in or assets that qualify for agricultural relief, as long as everybody's understood that the retention is the key, the assets are being retained, we've never worried about the 10-year charge, subject to the assets still qualifying. So it's been very easy for families to plan because they know as long as they retain the asset, we're fine. If they sell the asset, well, they've at least got cash to pay it, haven't they? Yeah. And we can do some planning potentially before we sell the asset anyway. So we've been able to advise with a considerable degree of certainty over a very long period of time for families to help them plan. Whereas we're in a position at the moment where we say, we can get you in, but we want to be very, very clear that we don't know what that charge yet looks like. We will do, because we've got to have the detail. That will come out of the consultation and we will get it. And then we've got to understand it, haven't we? Work out how it applies. And I'm really saying it might still be perfectly acceptable in the grand scheme of things. That might be a price to pay for moving the asset out of that generation.
Yeah. I have a feeling you're going to have a very busy year.
Yes, I'm just sort of wondering when I might book my son a holiday, Justin, at the moment. So I'm thinking maybe some long weekends might be a better strategy than try to find 2 weeks in July and August. That's currently where I am. Or post the 6th of April 2026, maybe.
Gosh. And then just returning to my world for a second, which is more about, pensions and other strategies, of course. I'm just imagining, I mean, you're very familiar with the probate process. But any probate that I've been a little bit involved with, just providing valuations or helping out lay executors with getting the information together, the probate can take a little time. And the idea that sometimes you can have a lay person doing the probate and you can come across someone with, 17 different pension plans. And the idea that 17 different trustees of different pension plans have all got to work out their level of inheritance tax they've got to pay seems absolutely farcical to me. But that's how I look at it at the moment and go, well, how on earth, especially, you've got £3,000 when you work for Tesco's and £2,000 when you work for Sainsbury's and then £4,000 pension when you work for Marks and Spencer's. Other retailers are available, but thinking that's your career moving from one high street retailer to another, you could end up with these, as I say, we've consolidated in the past. People who have just arrived with a lifetime of pensions at 55 and gone, I don't understand it, and I get it. I understand why they don't get it because they've got a varied work life, and they're trying to amalgamate it so they can understand. Well, not everyone does that, and the idea that each one of these trustees has got to pay their relevant amount of inheritance tax seems absolutely crackers to me.
It does, and I can't quite follow through how all those payments will be joined up together. I appreciate there's a payment reference number, but we can sometimes struggle when we're just trying to pay the inheritance tax on the free estate and we've got 3 or 4 accounts contributing to it. So you put in the pension pots as well and the liaison on that and the potential deadline on paying a tax. And it's very challenging.
Yeah. Okay.
But I think there is a message around pension consolidation.
Yes.
Because actually if this is coming and we end up with what we think we're going to end up with, consolidating one pension, it is going to be much more efficient than consolidating 10 or 15, isn't it, in terms of aggregating it and dealing with it.
Yeah.
I think there is a planning point there.
The problem is, of course, as we know, there are a huge amount of estates that go intestate. There are a huge amount of people in the UK who will never seek financial advice, and therefore, their estates might easily be within the nil rate bands, but they've still got to do the calculation. They've still got to gather all the executors have still got to show that the value of the estate, even if it's within all the nil rate bands, it's still got to be accounted for, hasn't it? And this is the worry I see, that for the people who seek our advice, yours and mine, I mean, they're probably relatively affluent and relatively got complicated affairs, and therefore that's why they're seeking advice. But for normal Joe, who's got a regular house and a regular pension plan of a couple of £100,000, etc., this is all still got to be done, and that's where I see the real difficulty.
So you could say, well, it's a great time to be an advisor because people need the advice. So that's simple for you and I, isn't it? But actually, it's also very challenging because I'm the sort of advisor that likes to provide practical options that I know will work. And that's what I've always prided myself on. And this is really challenging at the moment to say, well, we think it's going to be this. We think this is how it might work.
Yeah.
But we're not certain.
No.
And so one of the big points we've been talking to clients about, interested to get your view on, has been dusting off life policies. What have we got? And when did you last look at this? Is this potentially part of the solution? So we create a cash pot to deal with some of these challenges while we just work through the detail. So if nothing else, buying yourself some time and, possibly some sort of term policy to just give us all some breathing space. I don't know whether you've noticed a an increase in inquiries for that, or whether people don't quite understand the power that that might give them in terms of just breathing space.
Yeah, I think you're absolutely right. And whole of life plans are actually bizarrely very good value. They're often very good value because the insurers realise that the people don't pay them to the end of the term, but people can benefit from that. But I think maybe they will. If you take out a whole of life policy today, they will be held to term because, of course, they're there for the real purpose. And just for the listeners to understand life insurance policies, a life insurance policy is useful for paying inheritance tax for a number of reasons. One is, first of all, you need to write it in trust. So it's outside your estate, because what you don't want to do is add to the problem. You don't want to add more cash into the estate that the HMRC are going to get. But if it is written in trust, and the premiums are regular gifts out of income, which is an exemption, no problem at all for inheritance tax purposes. It can provide a lump sum to your beneficiaries for them to pay a tax bill, or to compensate them, in essence, for the tax bill that's been paid. So hugely beneficial. Of course, everyone needs underwriting, and the people who are more in need of this type of cover, of course, can be into their 50s, 60s and 70s. And of course, often may have some kind of medical issue by the very nature of getting older. The premiums can end up being much more expensive than they would have been, in your 40s in good health. So there are lots of complications. But if you do have a life policy, can it be written into trust? Can it be, even an existing policy, can it be put in trust and get outside your estate? I think there's even more complications what we're going to have around death in service plans. Lots of people have occupational pensions, which give. We have some executives we look after, 8 to 10 times their salaries is covered by a death in service policy, often written through pensions legislation. And whether that's going to fall into inheritance tax, I don't know, or a separate trust around those, or maybe, as you referenced before, a pilot trust to receive those benefits could be a good thing again. But life policies are definitely, I think, something that we need to consider much, much more than we have done in the past.
It's cash flow, isn't it? And I've got a few clients at the moment say, well, what we're going to do is just create some cash in the company, and we're just going to put it in an account, and that will help us. But of course, you have to point out to them, don't you, that to secure the relief in the first place, you've got to be wholly or mainly trading and not investment. And the sort of amounts you might need to stockpile to sort this out could potentially mean you lose the £1 million relief and you end up with nothing. So that isn't a solution. And, the cash has got to be created really outside, and a life policy structure would seem to be the obvious solution to that, or to at least have it as part of the plan.
Yes. So, to wrap all this up,
let's try, shall we? How are we going to do that then?
So what you said to me, if I can say that, you said, right, the first thing we need to do is value our estates. We need to understand what everything's worth, what our pensions are worth, what our kind of free, the home, the money in the bank, and then, of course, your business assets and maybe your agricultural assets as well, and understand what the values of all those things are. Then you can come along to someone like yourself and go, can you help me with a strategy?
That's absolutely it. That's the key to it, because otherwise you can only sit and have a hypothetical conversation, can't you? And you need the numbers and the tax calculation to be real and to be able to make a plan. And there is a nice segue then back to the life cover. And I promise I'm not on any commission rent life cover at all. But it just seems to me to be the obvious thing in terms of, well, if the tax liability at the moment is not very much at all, and under the new rules, we might be up at X million. And do we insure it short term, or, as you say, if a whole of life is reasonable? And then let's get into the gifting strategy, knowing we can lose the policy later on down the line.
Yeah.
And key is we've got to understand what the numbers are to start with. Otherwise, the advice will only ever be in outline, and clients need something very specific that works for them.
So we have some deadlines coming up. We have some consultations that we're waiting the further detail. We feel there may be a little bit a window of planning to be done between, the April 26th, the April 27th, etc. In the interim, but we've got to stay informed, I think, for the people listening. If this is a concern to you, stay informed. Listen into my channel, of course. Where can people find out more about you, Lucy, and the great work that you do? Because I'm sure you'll be putting bulletins out and newsletters and all types of things as the detail comes out.
Yeah, absolutely. We will obviously keep our website. So the Higgs LLP website's a really good place to start. We often share content on there, and we're actually, I think, going to be a little bit old fashioned about this and do some in person briefing once we've got the details. So anybody who's interested really in coming along to that and would be very welcome in due course. But we just want to get the details straight first before we embark on mass as a project. But there'll be plenty to talk about in due course.
Well, I do think I say this tentatively. I'd love to get you back onto the channel once we have a bit more detail and but a bit more meat on the bones type of thing, and we understand a bit more what we can do. That I just feel that your time may be so valuable by that point, I won't be able to afford you. Or you'll be pulling all your hair out. I'm not sure. Maybe I'll have to get, an all-paid trip to the seaside down here in Mudderford.
I'm sure we can come up with something, and it's been a real pleasure to hopefully chat it through and highlight what I think at least the starting point is. And it's understanding the issues, isn't it? If you understand the issues, you can start to make a plan, and all isn't lost. And I think I had a wonderful conversation with a client the other day who said to me, I think the key to all of this is just to stay alive. And I couldn't disagree with him. I thought it was marvellous advice.
Absolutely. Well, thank you so much for your time, Lucy. It's been fascinating and really enjoyable chatting to you. Your immense knowledge about all this and how you guide people to hopefully making a very difficult decision, I'm sure, with lots of personal emotions coming into play. But I really appreciate your time spending with me and our audience this afternoon. Thank you. Thank you once again to Lucy Obrey. To find out more about Lucy or what we discussed today, head to the show notes where you listen to your podcast for some helpful links. Of course, you can find those links on our YouTube channel as well, where you can subscribe. As always, if you've enjoyed this episode, please share it with someone you think will find it useful. For now, I'm Justin King, helping you feel more informed in your retirement.